Ah, the 1920s, a time of jazz, flappers, and more questionable financial decisions than a reality TV star buying NFTs. But it all came to a screeching halt in 1929, when Wall Street crashed harder than my hopes of ever finding my AirPods again. Welcome to M Squared. Today we're diving into the Great Depression's messy origin story, the 1929 Wall Street crash. We'll cover the causes, the global ripple effects, the lessons learned or ignored, and what could have been done to stop the economic train wreck. It's got greed, chaos, and a lot of expensive suits. Let's get into it before I lose all my emotional capital. So, what exactly caused the 1929 crash? Let's just say the 1920s were basically one big financial rave. After World War I, everyone wanted to party, but instead of glow sticks and dance floors, they had stocks. Ordinary people such as farmers, teachers, and your great-aunt Bertha were jumping into the stock market like it was Black Friday at Macy's. Stock prices kept climbing and people thought, hey, they'll just keep going up forever. Spoiler alert, they didn't. Here's the kicker, a lot of these folks weren't even buying stocks with their own money. Nope, they were borrowing it, what's called buying on margin. Picture this. You borrow $90 to buy $100 worth of stock. If the stock goes up, you're a genius. But if it goes down, well, you now owe the bank $90 and have a $10 stock to cry over. This worked great, until it didn't. Fast forward to October 1929. The stock market starts wobbling like a poorly made Jenga tower. Everyone panics and starts selling their stocks, but the more they sell, the more prices drop, which causes even more panic. By October 29, known as Black Tuesday, the market had fully tanked. Think Titanic-level disaster, but with less water and more ruined bank accounts. And here's where it gets even more ridiculous. Banks at the time were basically playing roulette with people's savings. Instead of keeping your money safe, they'd throw it into the stock market, because why not? When the market crashed, those banks couldn't pay people back, leading to a chain reaction of bankruptcies. It was like Jenga, but now the pieces are on fire. So what happened next? The crash didn't just stay on Wall Street, it spread everywhere like bad karaoke at a family party. Businesses shut down, millions of people lost their jobs, and suddenly the American dream was more like a really long nightmare. Families were scraping by, breadlines stretched for blocks, and the only thing rising was unemployment. But wait, there's more, he says, sounding like the madman from the original Scream film. The crash wasn't content with ruining just the US economy. Oh no, it went global. Europe, already struggling from World War I, got hit with a financial double whammy. Countries like Germany, who were relying on loans from the US, found themselves broke. And since misery loves company, international trade plummeted too. It was like the world's worst group project. Now let's talk about what was done afterward to prevent another crash. In 1933, the US government passed the Glass-Steagall Act, which said, hey, maybe banks shouldn't gamble with your savings. It also created the FDIC, which insures your deposits, so even if a bank collapses, your money is safe. Kind of like a financial life jacket. The Securities and Exchange Commission, or SEC, was also created to regulate the stock market. Think of them as the hall monitors of Wall Street, making sure no one cheats, steals, or buys on margin like it's 1929. And while these measures didn't magically fix everything, they did make the financial system a lot less chaotic. But here's the million-dollar question. Could the crash have been prevented? Honestly, yeah, probably. If people hadn't treated the stock market like a casino, if banks hadn't played fast and loose with savings, and if there had been actual regulations in place, things might have gone differently. But hindsight is 20/20, and apparently so is greed. So what's the takeaway? Well, history has a way of repeating itself. Whether it's the dot-com bubble, the 2008 financial crisis, both of which will be covered in future videos, or the time you bought Dogecoin, the lesson is the same. When it comes to money, don't let the hype fool you. And maybe don't borrow $90 to buy $100 worth of anything. That's all for today's crash course on the 1929 Wall Street crash. If you enjoyed this, or at least learned something without crying too much, let me know in the comments. Remember to keep your savings safe, your investments smart, and remember the stock market isn't a get-rich-quick scheme. It's a get-stressed-slowly scheme. Thanks for hanging with me. If you like this video, you're going to love the one on your screen right now. It's packed with even more great information for you to enjoy. Click it, and we'll see you on the other side.